The big liquidation event that took place back in March, which sent stocks, gold, silver and Bitcoin plummeting, was greeted with vast central bank monetary stimulus and has seen stocks soar to all-time highs amidst record retail volumes. The sheer scale of liquidity and the prospect of more to come is fueling a grave unintended consequence. Today we explore this substantial market risk, so let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Now, back in 2008, when we saw central banks globally begin their quantitative easing programs, it was acknowledged that there was a growing risk of encouraging what economists refer to as moral hazard. Well, in a year where we have seen a fifth of all dollars ever created pumped into the economy, it is little wonder that the stock market has taken flight. Of course, market indicators such as the Buffett indicator show us just how overvalued the stock market remains. And so moral hazard occurs when, in this case, investors are encouraged to take excessive risks in the knowledge that the Fed is providing an explicit guarantee via further bouts of quantitative easing to support those asset prices. Now, the intervention by central banks globally has caused a massive rush towards risk-on assets, and while precious metals gained across the summer, they have faced considerable headwinds into the fall, which saw gold prices well below their summer highs. Meanwhile, the S&P 500 has continued to make gains up from around 3,300 when gold hit its top in August to new all-time highs. Likewise, the TLT 20+ years Treasury ETF has sold off from its summer high. The vaccine news has further encouraged a risk-on attitude, and we've seen big price moves in copper, lumber and IPOs have just gone wild, signalling the potential for a substantial economic rebound, it would seem, into 2021. And so easy gains have been made by making bets on risk-on assets. The consequence has been that few are willing to actually short sell the stock market, as this chart shows, and this is to be expected when many hedge funds experience substantial losses in their short positions across Q3, and in a world where around 5 stocks have generated the vast majority of returns, hedge funds have had little choice but to crowd these trades. Indeed, Goldman Sachs have reported on the fact that we are now seeing at or near all-time highs on their hedge fund crowding index. And in this world of absent growth, the FANGMAN stocks have prospered significantly, as this chart shows. But just notice the S&P 500 returns when these stocks are excluded. Effectively, this leaves us with a centrally planned economic system where capital naturally flows towards these firms, a Sovietization of the economic system. And so the herd is moving in one clear direction for now, and fascinatingly, this is reinforced by the rise of the passive investing trend. The financial independence retire early movement, or FIRE concept, has long encouraged everyday people to focus upon indexed investing as a key means of minimizing costs and maximizing long-run returns. Indeed, the success and popularity of firms such as Vanguard is based upon the indexing strategy. And this is the direct consequence of the actions of central banks by insisting upon zero interest rate policies. As fund manager Louis-Vincent Gave points out, indexing is the new in vogue form of socialism. Capital is not allocated according to its marginal return, the foundation on which capitalism rests. Instead, capital is allocated according to the size of companies, just as in the days of the old Soviet Union or Maoist China. The bigger you are, the more capital you get. And so as we see ever greater convergence of trading strategies by hedge funds backed up by index funds, which creates a worrying lack of diversification, as momentum trades become more and more crowded, it increases volatility as stocks are bought or sold according to market momentum. Indeed, since January 2018, the S&P 500 equal weighted index has suffered 6 corrections of 10% or greater, including one drop of 20% and one drop of 40%. In contrast, the preceding 2 years, January 2016 to January 2018, the S&P 500 did not see a single 10% drop, while the July 2016 to January 2018 period didn't even see a 5% drop. So it seems a big environmental change has taken place. Now, given that the desired outcome for most portfolio managers is to achieve strong long-term returns while minimizing volatility, this creates significant problems. As trades become more crowded, lower returns are available amidst higher volatility. As the FANGMAN stocks rise, more capital is allocated to them at the expense of stocks whose prices have fallen. This can lead to an enormous misallocation of capital, which is amplified by the current climate of lockdowns and working from home. And so Louis Vincent Gave goes on to state that in the 20th century, the goal of every socialist experiment was for everybody to earn the same salary. In the 21st century, it seems that the goal of indexing is for everybody to earn the same return. As we now know, fixing everyone's return on labour at the same price was a disaster. People stopped working and economic growth plummeted. Fast forward to today, and why should we expect a different outcome if the end goal of our investment strategy is to ensure that everyone gets the same return, not on their labour but on their capital? Isn't the entire world of money management now orientated towards delivering this remarkable ambition? As the companies that least need capital are allocated the most capital, they inevitably turn towards buying up their own stock, as we can see in this chart, which highlights shares outstanding diminishing for both Microsoft on the right and Apple on the left. And so as the market moves ever higher, and if the risk-on environment maintains, as seems likely for now, these downside gaps are only going to become even greater. The key fundamentals that matter are liquidity and stimulus, and this is likely to keep on fueling ever greater complacency in markets, as Holger points out here in this tweet. And so in the rise and fall of the world's major civilizations, the elite have a choice to step up and tackle the problem and allow civilization to continue to thrive, or fail to deal with the problem and its root cause. That root cause is, of course, debt-ridden fiat currency reaching its terminal phase amidst a growing awareness of this problem and of those who are actually complicit with rampant wealth extraction. And this leads to the elite needing to tackle this issue desperately. Their response is, of course, the Great Reset and CBDCs, which are far from assured in terms of their success. And if they get it badly wrong, the risk of revolution grows. But certainly, while we remain risk on into year end, the bubble economies grow ever larger. Now, do let me know what you think in the comments below, and I look forward to seeing you next time. Bye bye.